Thank you, Taylor and Mo, and good morning, everyone. Welcome. Thank you for being here. On behalf of my colleagues, I'd like to say welcome, and it's a thrill and a pleasure to have sponsored this conference now for 17 years. Remaining nimble and achieving returns while facing uncertainty and volatility. It would be easy for me to say that's our job. It's what LPs pay us for. And it's not new. There's always uncertainty and volatility. And say, why don't we all go out and enjoy this beautiful day? But I'm sure that's not what the conference organizers want. And I think there's going to be some very thoughtful meat on that topic. I don't think this discussion is new. I think 17 years ago, we faced many of the same issues. We were recovering from the dot-com bubble. We certainly had uncertainty in the government, regulatory, and tax side. And we had heightened competition and new business models popping up everywhere. In fact, it feels a lot like 20 years ago when the period of irrational exuberance was coined. Millennials, look that up. And yet we still had years to run after Alan Greenspan coined that term. Certainly in healthcare, which is the perch that we sit on, this is truly a volatile and uncertain time. We have changes or potential changes to the Affordable Care Act. We certainly have volatile markets. We have sectors of healthcare that are down there with ISIS in terms of public opinion, namely pharma, PBMs, and similar areas. We have new and heightened competition. And that's a very interesting topic. That competitive dynamic in the last few months and year has become more interesting and, frankly, I think more exciting than ever before. In January, several hospital systems announced they were going to become generic drug manufacturing companies to address supply and price issues. Also in January, Amazon, Berkshire Hathaway, and JP Morgan fired a shot across the bow at healthcare. In fact, Warren Buffett called healthcare a tapeworm on the U.S. economy, saying that they were forming an entity to help address cost, improve quality, and improve employee engagement in their healthcare. And I think the most interesting player not to formally announce yet that they're entering the industry and that they're going to make things interesting, but no doubt will, and I think it's coming fast, is Apple. Apple has been hiring healthcare experts. It's no secret that Apple was in discussions in the fall to acquire 2 clinic businesses, to actually be in the clinic business. So instead of walking into an Apple store, you'd walk into something that looked like an Apple store, but with doctors and nurses. And I think that could transform and revolutionize our industry. So in conclusion, in my welcome, I would say uncertainty and volatility have never been new or never really not existed in the markets. We happen to think that some of the best investments are made during times of uncertainty and volatility, even perhaps when valuations are high, but they require nimble research and work, but represent opportunity for us all. So I looked at the agenda, the topics today. The people that will be speaking are absolutely fascinating and certainly above my pay grade. So with that, I'll be quiet and introduce Chris McGowan. Hold on, I have to say one thing about Chris. Well, actually, I have to say 5 things, but I'm only allowed to say 2. Chris is general partner of CGM Ventures. He is also the adjunct professor of entrepreneurship at Chicago Booth. I've had a chance to get to know Chris and serve with Chris on the Polsky Center Board, now the PE Council. I think he's an absolutely fantastic professor, person, investor, and I welcome Chris to introduce our keynote.
Thank you so much, Ken. Good morning, everybody. I am Chris McGowan. And I've got the pleasure of teaching many of our private equity experiential programs here at Booth. I'm going to tell you 5 quick things. Number 1 is that our flagship private equity venture capital and lab class is in its 19th year. Now, when we started, we just had 19 firms here in Chicago hosting 25 students, but we've grown to 65 firms hosting 110 students. So thank you to those host firms over the last 19 years. And if you are a Chicago private equity firm or a venture capital firm, and you have not yet had a Booth intern, you're missing out on some very good and very cheap, very affordable talent. So come talk to us about getting involved, please. All right, number 2, it's been 17 years of growth for this very conference. And I just want to thank, again, the amazing sponsorship of Ken and his partners over at Beacon Petty O'Keefe. Number 3, this is our 7th year offering the Sterling Partners Investment Thesis Challenge. Now, that's where PE firms work with our student teams on a thesis-driven sourcing exercise. So again, thanks to our host firms, including our name sponsor, Sterling Partners. And again, if you're a Chicago-based private equity firm and you would like a great student team to try to help you find a deal, and everybody needs a deal, look us up, call us up. Number 4, we are in our 3rd year of running the Oxford Chicago Global Private Equity Challenge. And this is a case competition where our student teams compete, putting together take-private analyses of public companies. We crown a booth champion team every fall, and then every spring, in fact, we're going over next week to take on the Oxford champion team. So we wish our team luck, and actually Water Street is sponsoring our team this year, so we thank them very much. And number 5, this has been a huge year for private equity programming again at Booth, in no small part, again, to our fabulous $5 million gift from Raymond Svider. I think that does deserve a second applause line, folks. Thank you again, Raymond. And yes, and this gift is, again, to endow and name the Svider Private Equity Program at the Polsky Center. And Raymond was GSB 1989, and he will speak to you soon in this morning's keynote. So we are putting Raymond's gift already to some very good use. We have hired another entrepreneur in residence to focus on private equity at the Polsky Center. We are building out a workshop series for alumni who are trying to understand private equity more. We have another set of workshops focused exclusively on women in private equity, and other important timely topics. We also launch Booth's twice-a-year Private Equity Digest with updates on alumni deals, faculty research, and more Booth-related private equity news. And there will be more programs to come. So it's been a great 19 years that we've been offering experiential programs in private equity here at Booth. And stay tuned, though, as we are just getting started. Okay, so now I'd like to introduce the first keynote duo this morning, conversation between Steve Kaplan and Raymond Svider. Steve is the Neubauer Family Distinguished Service Professor of Entrepreneurship and Finance. He's got the best title at the Booth School. And Raymond is the co-chairman, and managing partner of BC Partners, and he is located in New York City. So gentlemen, over to you. Thank you so much.
Okay, very good. Our chairs are arriving just in time. Okay, you take that one. I'll take this one. Thank you. Okay, well, thank you so much, Chris, for the introduction, and thanks for everything you do for us. Chris is tireless and awesome, and I'll give Chris a big round of applause. And I also want to reiterate, Taylor and Mo have done a fabulous job organizing this. They were on top of everything at all times, and I want to thank them. So thank the two of you. Okay, so now it is my pleasure to sit here with Raymond. And Raymond is a managing partner at BC Partners. BC Partners has AUM of over 16 billion. What's the number these days? 17, 18 billion dollars. His most recent fund was $8 or $9 billion. 8.6 billion dollars. Okay, who's counting? And Raymond joined BC Partners in 1992. He moved to the London office in 2000 to do technology and telecom, and then he moved to New York in 2008 to lead the U.S. office. So he's kind of been three very different places. It'll be kind of interesting to know how those were different, so we'll hear about that. And his more recent investments include Intelsat, Multiplan, which is, that's the healthcare space, right?
Yeah.
And currently PetSmart, where Raymond is the acting CEO. So if you have questions about pets, he's your guy. Before VC Partners, he worked in investment banking and in consulting at BCG. And he received his MBA here, and he did his undergrad degree at École Polytechnique in Paris. So again, please join me in welcoming and thanking Raymond. So what I'll do, I'm going to ask Raymond some questions about BC Partners, some questions about his view of the industry, and then we'll get his advice about what to do with your lives. And then I'll leave a little bit of time at the end for questions from the audience. So start thinking about some questions. So I guess I'll just start off. What does BC Partners do? What's your strategy? How do you think about the PE world?
Okay. BC Partners. So we are a mid to large cap buyout firm. We've been set up exactly 30 years ago, or no, 31 years ago now. Originally European, obviously, and we started investing in the United States 10 years ago. So, in terms of equity check, it can range from 150 to 200 to $1 billion. We try, certainly in the current environment, to sort of have a mix in terms of portfolio construction between like smaller deals with, obviously those deals are not that small in the, like $400 to $600 million range, and much larger deals, so deals with more growth and some ones which are more established. About a year ago, we also started to diversify. So in terms of PE, we invest in Europe and the United States and Canada. We diversified into credit about a year ago, so we're building up a credit business, which is a very, very synergistic and exciting space to the extent that you have the right people, which I think we do. And we're pretty soon going to announce a third strategy, also quite complementary to what we do. And so that's as far as BC Partners is concerned. Our current fund, which we just finished raising, is 8.7 billion euros, $8.6 billion, already 30% invested. And that's it. Your other question was what, the PE industry?
Well, we'll get to that in a second. How do you view your differentiation? What do you, what did you tell your LPs? And
what did our LPs believe? That's a different question. Well, we have one LP here, so maybe Marcel is going to tell you later on what he believes. Ultimately, your differentiation is, it's twofold, and it sort of varies between the different continents. I mean, in Europe, obviously, we've been investing, and we were one of the early, investors in the continent. And so, in Europe, it's a mix of very, very deep networks in markets which are less transparent, I guess, than the US. So, Germany, France, Italy, the Netherlands and stuff like that. And clearly there, when you've had network, track record, reputation for many, many years, and obviously locals, that gives you somewhat of a competitive advantage. I mean, it's not a silver lining, but it's a competitive advantage. And you combine that with clearly, a huge amount of sector experience over the years. So, I think that's where we differentiate ourselves. In the US, obviously, the market has not been waiting for us, but we've been here 10 years now, and we've built the business around, first some of the sectors and companies that we knew very, very well from Europe, and where, because of that, we had a point of view, and then to build the business around, piece by piece, around what you have. At the end of the day, frankly, at least in my mind, what differentiates a firm, any firm in private equity. It's a combination of, structure, how you're structured, your processes, your governance, and at the end of the day, the team and the quality of the team, quality of the individuals, team dynamics, depth of team, and the mix of resources and what you can bring to bear to an investment. I mean, clearly, for us at least, being European, the DNA of the firm at BC, the four founders are not anymore with the company, but the DNA of the four founders, they were all from industry or investment or management consulting, so they were very, very, close to businesses, and it's all about, like having the right judgment on a business. And I think that's the DNA that we've managed to keep. And when you read in the paper that 20 years ago private equity was making money because of financial engineering. I mean, this is like all like crap. It makes absolutely no sense. This is not how our industry has been making money. But clearly the ability to identify the right business, make the right judgment, and more importantly, follow and steward your investments over the years, is a key differentiation, which is a mix of, people, culture, and processes.
And how do you do that specifically? So when you get a deal, what are the things you do to evaluate it?
Oh boy,
And who does it? You hire outside people, you do it internally?
So, I mean, there's no manual, unfortunately, in private equity. So, these are the processes. And,
I need a manual.
As long as you check the boxes, you're going to do well.
I teach this. I know.
Maybe with AI, there's going to be a manual. But no, how do we do this? First of all, we do this, by putting teams together of people who are, quite experienced. And, frankly, every case is specific. You're trying to understand the inherent strength of the business, competitive advantage, of course, which can come in many different ways depending upon the industry. The risks, obviously. The upside, how you're going to create value, how can you grow this business, what are the risks, what are the mitigants, what are the levers you can use, and you need more than one levers, in order to create value. What happens if things go wrong? What can you do? What are your degrees of flexibility? At BC, we, contrary to many other firms, actually, we tend to be quite religious about not using that many management consultants. Frankly, as far as I'm concerned, I think it's my job. I don't want to have McKinsey or Bain or BCG, to tell me what they think of the business plan. I mean, it's actually my job to make the judgment about the business plan, not theirs. We do use sometimes people, for very, very specific, either in specific industries or stuff that we cannot do by ourselves. But typically, we like to do most of the stuff ourselves. I think we have the capabilities to do that. Most of our staff, come from consulting, investment banking. They're very well trained, and we dig very, very deep. So, obviously, I'm not talking about lawyers and accountants, which you need to use, because those are not like capabilities that we have in house. But the rest, it's usually a small team of between 4 and 6 people. And we dug in, and that includes myself, because ultimately, on every investment that I lead, I'm the one who's responsible. So I can't turn around to somebody else and say, how did you, make that mistake? Ultimately, it's my mistake. I think that's the success of any firm. People at the very senior level need to be hands-on, roll their sleeves, and lead the investments by themselves. Because there's a lot of experience in this business, and the judgment comes with experience and with a lot of hard work.
Interesting. So you do a lot of work on the business. I take it you evaluate management too?
Yeah.
And how do you do that?
It's an art. It's not a science. Yesterday at the council, the PE council, some firms in the industry tend to have very strict processes. We don't. The more you work with people, obviously, the more you have you develop a view as to what their strengths and weaknesses are. And that's typically how we do it, frankly. Now, clearly in certain cases or in a number of cases, we take background checks. In a number of cases, we try to talk to as many people as we know who know them or know of them. And that plus, the experience that we built, on our own, interacting with those management teams, leads us to make the judgment as to can we back those people, where do we need to strengthen the team, what type of capabilities don't they have, which people we need to replace, frankly. Then that's part of your, sort of roadmap. We don't have a very strict, process for evaluating management using outside people. I'm not sure it's totally, it totally makes sense. In a lot of situations, it's actually really difficult. But clearly, it's part of our job to gauge the partners and the management teams that we deal with, and to take action when we need to.
Now, do you have a view which is more important, the business or the management? I know they're both important.
If I had to choose if I had to say one or the other, I'd say, it's really difficult, It's really difficult. I have examples in my head whereby there's been, the business was so great that the quality of the management team, just didn't matter. But I would tend to say the management's more important, actually.
Very interesting.
Because even in a very hard industry, very difficult business, great management team can make a huge difference.
So that's really interesting. And I'm going to ask this all, throughout today, because it's something that students ask, and it's something that, there's difference of opinion. So it's very, very interesting. So can you give the other thing that people always ask, going back to your thing about financial engineering versus not, they say, where do the PE firms actually add value? So can you give a couple of examples about where you think you added some value?
Sure. First of all, I think holistically, as far as I'm concerned, PE firms add value for a very, very simple reason versus, I think any other form of governance actually, is because you have better alignment. You have more experienced people in PE than typically public boards. You have.
Thank you very much.
I really believe that. I mean, that being said, public boards is a very effective governance system, but, I've been on public boards myself. And, I'm currently on 2 public boards, actually. And, even if you have very, very, very experienced executives, it's a question of knowledge and time. And so, with private equity, what we do is make acquisitions. What we do is think of those things. If you're an operating executive, if you're a very, very successful operating executive, a CEO, whatever, you don't do acquisitions every day. You don't think of those things every day. You don't do financing every day. You have a CFO that does all of these things for you. And you have a different depth of knowledge, but that is not a depth of knowledge that you can apply as a public board member, because you get there for 6 boards a year or something for 3 or 4 hours or 6 hours, and you have 3 hours of reading beforehand. That's the extent of your involvement. In PE, you have people who do that for a living, who are very, very experienced, whose personal economics are 100% aligned with the success of the investment, which is not the case in a public board. And ultimately, who can make the decisions by themselves. In a public board, you have depending on, very often public boards are 12 members or something. How do you make a decision amongst 12 members when you need to fire the CEO? It's a very, very, it's a high bar. You always have someone who says, oh my God, but that's risky, and what are the, and in private equity, thank God, you can make those. I mean, those are still hard decisions, but those are decisions that you can make by yourself, and that makes a lot of difference. So, specific examples. Specific examples. I think what we're doing at PetSmart right now, which is something that takes 80 to 90% of my time, currently is probably the deepest example of adding value and changing a business. And I could probably talk to you for the next 5 hours as to what we do. But we've totally changed the priorities. We've changed people. We're going very, very deep in, like, supplier relationships, promotional effectiveness, stuff that is incredibly operational, actually, and where you discover that, things that were being done were not necessarily being done with the level of rationality and control and coherence that you would want, and that you can improve very significantly, although it's not easy. But in that case, you can only do it to the extent you have control. And in the interim period at the moment, when we are hiring the new CEO, this is something that that we do ourselves, which is actually a fantastic experience because it totally supplements the experience of a private equity executive, as far as I'm concerned.
Very interesting. So going from the qualitative, what are you doing quantitatively? So when you look at a deal, are you looking for discounted cash flow? Are you looking for an IRR? Are you looking for a multiple? How do you evaluate whether a deal's worth doing quantitatively?
Well, I mean, the first element and the most important by far, obviously, is the operating model. So the operating model of the business. And to do it, and obviously that depends upon the whatever the specifics of the company. How do they report? What type of segments they have? What are the drivers and all that kind of stuff? And how do you model that? And what are the sensitivities around it? And what are your base assumptions and the sensitivities around it? And what you can do in both the upsides and the downside to mitigate or facilitate the impact. Once you have the operating model, then the question is, of course, how much free cash flow do you have after you've allocated enough, investments to finance the growth and to realize, whatever objectives you have. That gives you how much debt you can put on the business. And then the question is, obviously, how much equity you're going to put on top, and what do you think a reasonable range of exit multiples is going to be. And that gives you the price. I mean, at the end of the day, that's what it is. And then what you look at is the sensitivities, to understand, how much cushion you have. And fundamentally, you have a base case return, but what's the range of outcome? Is the range of outcome between, like losing your money like 0% and 20? Is it 10 to 30? Is it totally skewed? Is it a very, very narrow band of returns, which happens from time to time? And then, I mean, once you have all of that in your head, which is obviously more of an art than a science, is the question of, okay, given the risk-reward profile of this business, given where we think we are in the cycle, given what you already have in your portfolio of that fund in terms of portfolio construction, like, should I put this, to the extent I can win that deal at that price, should I put the deal in the portfolio or not? So it's not that simple. It's not. And at the end of the day, it's obviously a judgment call. There's 100 reasons to do every deal. There's 100 reasons not to do every deal. And then you've got to plunge and then live with it.
And our target, where are you seeing target IRRs now, if you're allowed to say, and if you don't want to say, I guess.
No, I mean, it's a very, so it's kind of funny. LPs and the market typically, I mean, seem to have the view, or quite the general view, that IRRs are going down. Actually, it's not my view. I think it was very, very true before Lehman. I think post-Lehman, most firms in the industry, all of the friends I have in the industry, I mean, nobody underwrites in earnest a deal at 15% IRR. Nobody does that.
So it's closer to 20 now. That's good.
I mean, in the past 10 years post-Lehman, as a firm, we've probably underwritten, I don't know, 1 or 2 deals. Even if I include the deals that we've lost, there's been less than 5 with, genuinely an IRR below 20.
So, okay, so
yeah.
that's
now,
very
you can get it wrong, of course.
Of course, you can get it, and you can do better than you thought.
But because it's risky. And if you underwrite, I mean, I don't think LPs are paying us to generate a 16% IRR. If you generate a 16% IRR gross, net of fees, you're going to be in the third quartile or the second quartile. So that sort of doesn't work. And I think even in the current environment, it's actually not that easy. But if you stay disciplined, you can find deals. You don't find deals at 30% IRR. Certainly in the segment of the market in which we play. But you find deals in the 20-25%. Yes, 25% is hard. But sometimes you can get lucky, and because of specific situations or something, you generally believe that you can get closer to 25% than 20.
Okay, so that's very positive. So segueing from that, it sounds like the overall PE market. What do you think of that? What are your views? And is there too much money? Is there too little money?
Personally, again, I don't think money in PE is the issue. The market, I think, is difficult. There's no question about it. The market is very expensive. I think it has nothing to do with the amount of money that is available in PE. It has to do with something which is totally beyond our control, which is public market multiples. And public market multiples are what they are. They provide some form of benchmark in any transaction quite naturally. You don't control them, and they're very expensive. It has nothing to do with how much money is allocated to PE or not. And public market multiples have been rising. They've been defined by supply and demand. They've been very, very largely influenced by QE, quantitative easing, and policy decisions. And when a sector trades at pick a number 15 times, it's kind of difficult to do a transaction at 10, right? Particularly when the public markets for IPOs are widely open, which has been broadly the case, with certain brief exceptions in the US for the past, 4 to 5 years at this point in time. So that's what sets the benchmark. It has nothing to do with competition. Do I wish that there was less money in private equity? Of course I do. But it's, I don't think it's going to happen. But the real issue and what makes our job difficult is, the level of public markets. Now, that being said, it's something that applies to the whole industry. So it is our job in whatever environment we face, to find good deals, and to try to find stuff that makes sense, which is difficult, but it's that's what our LPs pay us for.
So is there anything, so there's money, you'll be doing deals, the prices could be lower, but they are what they are. Anything else you see happening in the future, or what do you see happening in the next few years in private equity?
The only thing I really worry about is the level of pricing in the public markets. If you remember after the election of President Trump, everybody thought that the stock market was going to crash. And at least so far, the opposite has happened. And a lot of people are thinking, that there's going to be a correction. And, there was a little bit of, something a few weeks back, but it seems to be quickly forgotten. So, what I'm more worried about is supply and demand, which, I think, and I fear will continue to sustain high public market valuations. At the same time, obviously, there's fewer and fewer publicly quoted companies, which I think, scarcity effect. And so, I think that's going to continue to make it, quite difficult for our industry to operate. Now, that being said, LPs continue to allocate an increasing amount of money to our sector, for, at least from everything I've seen, for good reasons. And I'm not saying that because that's what I do, but objectively, alternative assets have produced better returns and more stable returns than the public markets. And in an environment where public markets are where they are, it's kind of difficult to see a huge amount of upside investing in equity. In an environment where interest rates are probably going to go back up, how quickly and how much nobody knows, is going to be quite difficult to make a lot of money in the bond market. And so if you're a big pension fund or a sovereign wealth fund or something, and you're looking for, big pension funds in the U.S., they're looking, depending upon the pension fund, the public ones, they're looking at, 7.5 to, usually 7.5%, return in order to meet their future obligations. That's kind of hard to do. If you're, if you're CalPERS, and I forgot how much CalPERS has as AUM, like $250 billion or something, that's kind of hard to do. And the only asset class that has been able to produce, returns in excess of that, including in bad years, frankly, including, through Lehman and everything else, has been alternatives.
No, the returns have been consistent and
so,
reasonably good. So very interesting. Okay, so positive, people should still think about the industry. Cautiously optimistic, so good. So those of you who are here who are interested in private equity, it'll still be here going forward. So the next question is sort of understanding your career and then understanding what they should do. So how did you get into private equity, and how did you, succeed in private equity?
How did I get in? When I got out of school in '89, obviously the internet did not exist. The level of awareness and understanding of what all of this was about was very limited, and that included myself, of course. Before business school, I'd worked in consulting, and I was, frankly, I was just curious about what private equity was. I had no idea what it was, but I thought I've understood, and what I liked in this is the fact that you make your own decisions and that you can follow up and you're accountable for what you do, which is not the case in any of the businesses where you're an advisor, you're an agent, but you don't live with your decisions, you don't make the decisions, and you're not accountable for them. So after business school, I did not apply to private equity because I thought I'd never had a chance. So I worked in investment banking in what was a high-flying boutique at the time called Wasserstein Perella. When my sort of two levels up boss, who I was very close to, left, and he told me he was leaving, then I decided to leave because I never really liked investment banking that much personally. I don't think I was I was made, at least it did not fulfill me. And that's when I was in Paris at the time, and that's when I started looking in private equity. And there were not that many firms. I interviewed with 2 firms. I got 2 offers. I took the least obvious because everybody told me to take the other one, or at least everyone I consulted, and I made the right choice. So that's how I got there, like 3 or 4 years after leaving Booth. How did I succeed? Well, look, I don't know. A lot of hard work, drive, persistence, and I think courage, and ultimately you learn as you go. You develop your own style, and I think, at least as far as I can have, whatever self-awareness I have of myself, I think the qualities in, to succeed in private equity correspond pretty well to my personality. I think at the end of the day, that's the reason, and because I like it. If I didn't like it, I wouldn't have succeeded.
Now, what's the best part of the job, and what's the worst part?
The best part is the intellectual challenge, as far as I'm concerned, because every topic is complex. You have to make, sometimes really, really tough decision with a huge amount of uncertainty, and making those calls is not easy, particularly when you're accountable for them, and that's, you can get it wrong, and so to me, that's the most exciting part of the job, and to do stuff which you're not familiar with, to do stuff which is difficult, having been the acting CEO of PetSmart for the past 6 months, there's a hell of a lot of stuff I'd never done. In my first 2 weeks, the head of customer experience and marketing says, okay, we need to make the commitments for TV ads for the first quarter of 2018. What do you want to do? And I said, I had no idea. I don't even know. I don't even know how to buy TV. So walk me through it. What do you want to do? And then we had a few meetings, and I made a call. So that's the intellectual challenge. That's what's fun. What is less fun? What is less fun? What is less fun is fundraising.
Yeah, okay.
Because that's just, I don't think it's necessary, of course, and it is a partnership. But, I don't think, it's certainly a necessity, but it's not the fun part of the job. What is less fun is when you have to fire people, because that's never pleasant. And, but that's also a necessity. You do it for a reason, and you have to learn how to do it in the right way. But that's not fun. What's not fun is dealing with, we're a partnership, and most private equity firms are partnership. When dealing with, issues within the partnership, which do happen from time to time, and that's not fun because it's a bit of a waste of energy. But you've got to do it as part of, your job in driving a firm. So those are the not fun pieces.
So
less fun pieces.
The less fun, but largely fun. Did anything you learned at the business school help you, or I should say, I ought to say that more positively. What helped you from here? What did you take out of here?
Obviously, I couldn't have done it without going to Booth, as you can imagine. Look, there's nothing specifically that I can say. I took this course in finance, and it was really, absolutely eye-opening. And without this, I would have never managed to succeed in private equity. For me, obviously, I'm not American, so going to Booth was both an education and was an engineer by background. So, I didn't have necessarily, obviously, I'd worked at BCG, so therefore I had, an exposure to business. But, this was not. So there were two elements to me of the experience. There was the educational experience, the business and finance curriculum, and at the same time, obviously, the social experience and living in the US and everything else. So to me, that was invaluable, obviously. And, I don't think I could have gotten into the Circle, Washington Prada and all those firms at the time without doing Booth. So that was incredibly helpful. And I think at the end, the diversity and the diversity of experiences that you accumulate over the years is what makes you who you are, and what sort of colors how you react on a day-to-day basis, the decisions you make, how you deal with people. And from that perspective, Booth was an important part, of course, at the time, and continues to be with me. So, but is there anything like incredibly specific that made it? I don't think anybody would be able to say that.
Okay. Now put yourself in the student's shoes, and there are two advice questions, and then I think it'd be time to take questions from all of you. So first of all, how should they, if they want to do private equity or something related to it, how should they do it? And then, is there anything they should study or do while they're here?
Mm-hmm. Okay. What I sort of said yesterday, if they want to do private equity, how should they do it? I think, first of all, it's really difficult. I very much believe that a lot of people are looking at private equity, are excited at private equity for the wrong reasons. And so the first thing I think, anyone should do is trying to assess whether you have the right qualities to succeed in that industry, and whether you think you're going to be happy doing it, because ultimately I believe, I mean, that's what Marcel was saying yesterday. I strongly believe that this is the key to success. It's not, you don't wake up in the morning and go to work just because you're going to make, another few $100,000 or whatever it is. That, I mean, some people probably do that, but, that's not what motivates, anyone. And so what motivates someone is, what satisfaction, what deep satisfaction you find into what you do every day. And a lot of people are not going to be, most people are not very good at making decisions. Most people, no, but that's true. Most people are afraid of making decisions. Most people are not comfortable making decisions. And so you need to find that in you, which is not a piece of advice, but it's a piece of advice because otherwise, I don't know if you're going to get into private equity. I'm not sure you're going to be successful at it. Now, if you want to do private equity, it's a very hard industry to get into because it's a collection of small teams and small firms. The industry is obviously very much more mature today than it was, when I got in. And therefore, the number of spots are, few, far and few. And, you need to be at the right place at the right time and, frankly, be a bit lucky, okay? So, it's a question of networking, and having a huge amount of perseverance because otherwise it's never going to happen. Now, it's not a great piece of advice, but, I don't think, again, there's a silver lining here. You've got to be persistent, but frankly, if you want to be an entrepreneur, you've got to have exactly the same quality. It's not going to come like this, and you need to work very hard and are very determined. And usually, in a lot of cases, or in most cases, that pays off because you can see the drive in people, and that's a key differentiator amongst most people, frankly. So what else should you do? Is there anything that you should? Is there any specific class or whatever that you should do at Booth? Somebody said something interesting yesterday, and Mo said something which is totally right. After business school, if you get into private equity, what's going to matter to you and your employer is rigor, technical skills, to be able to grind a bunch of stuff and be very dependable. And accurate, because in most of those firms, we can't sort of check things 100 times. And people, even at a very junior level, are, have to be accountable for what they do and have to be, to get it right the first time, most of the time. Obviously, as your experience grows and as you grow in age, things change. And and at that point in time, the ability to relate to people, the ability to to judge people, the ability to make people want to deal with you versus you, is very important. In private equity, obviously, it's not all about I'm going to deal with somebody I like, but even with big corporates at the same price, you're going to pick to work with who you prefer to work with. And it's a fact of life. And sometimes you're going to do that even at a slightly lower price. And so, what qualities do you need to develop in order to be, quote unquote, the buyer of choice? And obviously, you're never going to be the buyer of choice in every situation. Some people may like you better, some people may like me better. So it's it's what life is all about. But all of these soft. So if I were at Booth, it's not all about finance. It's not all about all of that kind of stuff. I would go more for quite a diverse, diversity. And frankly, at least from my perspective, what really matters is business judgment. And so whatever you can do, which are more the business-oriented courses as opposed to finance.
Oh no!
You need the finance as well, but I think the business is much more important ultimately. So whatever you can do but you can do that with what Polsky does. Yeah, you can do that with, in a lot of other ways, to try to really develop, how do you think of a business, like how do you figure out whether it's interesting or not? Mm-hmm. In what we do, you take any business that is for sale. There's not a single business that is for sale that is not growing, for the next 5 years, okay? They all grow. And they all, and some of them like, 3 to, but a lot of them grow at like 10%, right? Clearly this is not what's going to happen. So how do you figure out the ones that are going to achieve that or close to that and the ones that are not and where, most of it is mostly spinning? And those are the qualities that you need to try to develop because ultimately that's going to be what differentiates you from, people who just buy, whatever's been presented to them.
Interesting. Well, with that, I am very happy to take questions. I've got a couple more, but I will take them, and we'll go there. Yep.
So you talked about how in your career, when you're choosing between a private equity firm, you make the less obvious choice. So today, when you're looking at deals, there's probably the temptation. There's probably the temptation to look at either the perfect deal and highly competitive, pay a big multiple. It's had hockey stick growth in the past. It's going to have hockey stick growth in the future. Great management team. High multiple there, or do you go with the less obvious choice, the company that's faced some headwinds, it's the hidden gem potentially, you could buy it for a much smaller multiple. What have you found to be the better investment?
In the current environment, the perfect deal is too expensive. To me, it's very, very simple. Like right now. It hasn't always been the case, but right now, the perfect deal is way too expensive. The risk reward is totally skewed, it's personal view. I mean, can there be exception in the world? Yes, there was one recent deal which I think was an exception, but it was for a lot of specific reasons. So in the current environment, you need to look for stuff. That's certainly what we do at the moment. We look for stuff which is less obvious, which is unloved, which is tougher, where you need to do transformation, where but where the risk reward is skewed in a different way. To me, there's no question. In the current environment, the perfect deal is way too expensive.
Okay. Go ahead.
Yes, quick question here. Based on your experience with Europe and the new tax changes here in the U.S., what do you see from a European perspective with U.S. tax law changes, and how also do you see that affecting valuations in your IRR?
So the question is, how does the new tax law in the U.S. affect, I guess, U.S. deals and also Europe? And that's a question, U.S. versus Europe, since you play in both. What do you like better?
It's kind of funny. LPs often ask that question. Like you have a meeting. What's more attractive to invest today? Is it Europe or the U.S.? What I found the most surprising, actually, is that the answer to that question, basically can vary every 6 months. Right now, in my view, U.S. is really, really tough. Last year we managed to find quite a surprising number of situations and deals in Europe which we liked, whereas we found it very, very difficult in the U.S. But it changes very, very quickly. So. Frankly, from our standpoint, or from my standpoint, that because of that, there's a huge benefit of having an investment platform in the U.S. and one in Europe, because if you want to invest, which is the right thing to do, and what LPs want, at a pace which is relatively regular over the investment period of a fund, having both geographies and teams on the ground, to try to unearth those opportunities is actually the right thing to do, because that's what's, if you were just in Europe in 2012, for example, it was absolutely impossible to invest for probably for 18 months in Europe. That's when there was the Greek crisis and all that kind of stuff. It was almost like 2009 in the U.S. Not quite, but very, very similar. And so having both is very important. In U.S. tax law, personally, I don't think it's going to make a huge difference. The 30% interest deductibility on EBITDA and then EBIT from 2022, I believe. In most cases, is not going to bite. in most cases. In some cases it can bite, but in most cases it's not gonna create a huge, the 3-year hold is not gonna be an issue because, unless, it's rare that deals are held for less than 3 years. So I don't think it's gonna make a hell of difference. The only thing, thinking loud, where it could make a difference is that, is that with the cash repatriation from a lot of the U.S. multinationals that have cash abroad, if they use that cash, and Intel, I think, was it Intel or I forgot which other firm has recently said they were repatriating $65 billion or something because of the new tax law. To the extent that that fuels acquisitions and more competition from corporates, then that's going to affect our industry. And that's a real possibility. But like the firms, the big public companies that have big piles of cash, are mostly Google, Facebook, etc. So those guys don't affect our industry that much, I believe. But anyway, I don't think it's going to be a game changer either way, in a meaningful way. Can it change around the edges? Maybe, but I don't think it's going to be a huge game changer.
Okay, well, this is now 11. We are out of time, and let me again thank Raymond for a terrific conversation and a terrific gift, and thank you.
Thank you. Pleasure to be here. Thank you.